Let's take a look at one counter that is buzzing away in trade. Capri Global is the one that you're looking at. In fact, that's in focus after the company raised 2,000 crore rupees via QIP. Harsh is joining in to help us out with some more details.
Well, yes, not just that, and that happened maybe a while back, the 2,000 crore fundraise, Shreyansi, but more importantly, it's about the valuation at which they achieved that 2,000 crore fundraise, which is at nearly 3 times book, which was impressive. And you have a slew of investors as well. And some very interesting names within that slew of investors. You had Quant Mutual Fund, 3P Investment. You had Abacus, BlackRock. You also had domestic investors being ICICI Pru, ICICI Lombard, SBI, HDFC, Ergo, HDFC Life, PNB MetLife. So a slew of investors showing interest. But let's try and understand how not only this company, but the space as a whole is evolving. And Rajesh Sharma joining us, Managing Director at Capri Global Capital, joining us live. Sir, first off, congratulations on this very successful raise at nearly 3 times book. Was an impressive one at all counts. Just give us the perspective. What does this fundraise do to your capital adequacy? And what does this give you in terms of growth runway? For how long does this equity raise last you?
Yeah, thank you. So this 2,000 crore of capital will make our capital adequacy ratio somewhat in the range of about, if we put it to the March number, it will be about 36%. And our growth runway with the co-lending guidelines in place, where about 18% book is in the co-lending arrangement, we believe that up to 50,000 crore rupees of AUM, this capital would be adequate. So and that we are trying to reach by FY 2028. That is our internal aim. So if we can do that, till then the capital adequacy will be adequate.
Understood. So what do these investors bring to the table? Because in relative terms as well, it's a large fundraise, even for your standards, because now the market capitalization is at 15,000 crore. This 2,000 raise is quite large in that sense. What do these investors bring to the table, and what's the expectation like in your conversations with these investors?
So these investors bring a lot of responsibility on us, that we have to behave responsibly in terms of asset quality. We should not give any surprise. We should do the sustainable growth, and we are committed that we will honor the faith shown by them. Since we are only in secured segment, but yet diversified with the MSME, gold loan, retail construction finance, a micro lab against property, and housing finance through subsidiary, with these 5 only secured collateralized segment, we are planning to grow at the pace of 30%. As I said, we will reach to 50,000 crore AUM by 2028. Now, we are not targeting growth alone. Growth has to be along with the sharp focus on the asset quality and keeping your yield intact, your margins intact. So the whole focus is continue to remain focused on the asset quality. There cannot be any compromise on that. Plus, growth is not adequate. Growth has to be particular yield levels to maintain your margins. So our focus is growth with asset quality, with keeping your margins spread intact.
Got it. So is the growth of around 30% going to be linear across all your lending verticals, or is there going to be a predominant focus on growing 1 or 2 and maybe the others grow at a slightly slower clip? What's the kind of mix that we expect by FY28?
So FY28, we believe that gold will be in the range of about 40%, and the rest of the segment, MSME plus micro lab, will be about 20-22%, and construction finance will be about 17-18%, and about 20% will be MSME. This is the range. It can vary between 2 to 3% here and there, but by and large, it will look like that.
Gold lending norms that the RBI has put out, of course, diluted and likely in your favor. But what would the impact of that be on your business? And you believe that you're in compliance with pretty much all of them. Are you comfortable with that?
Yeah, we are comfortable with that. I think the co-lending guidelines are now more clear. They have also allowed the non-priority sector loan also. And they have also involved some of the guidelines said that it should be more focused on the CLM1. In a nutshell, I think the regulator have provided more clarity. So that will help us to adopt that. And I think banks are also equally keen in the co-lending model because their retail exposure also goes up without taking a specific risk on the NBFC. And the benefit of co-lending ultimately goes to the smallest customer whom banks are not able to reach. So with the collective togetherness of cost of fund efficiency coming from banking system and collection efficiency, origination capability coming from NBFC of the world, I think this is a good partnership, and we believe that co-lending will pick up further from here.
I want to talk about cost of funds. 100 basis points is what the RBI has shaved off the repo. How quickly does that reflect on your numbers? I'll come to spreads in the next question, but first let's try and understand cost of funds.
So first of all, it reflects the moment the mood become very, very buoyant in the banking system that credit has to be enhanced. If you see a couple of days ago, even our honorable finance minister have also advised bank and us the credit flow should increase. So I think there is a clear focus and synchronized across government, regulator, and also with the lenders. Now credit has to be go in a manner that it reaches to the last mile, and the country should reach towards our target of becoming the third largest economy. And that focus remains. What brings it immediately on the table, that positive buoyancy in the mood. Whether it reduces the cost, answer is no. Only on the MCLR reset date, your cost of fund goes down. But the incremental borrowing, what we are going to do, that immediately becoming at a lower cost because MCLR have already gone down. The co-lending, which are linked with the repo rate, the benefit has come instantly, immediately on the existing borrowing as well.
Okay, and what does that do to spreads? How much of this gets transmitted? And your spreads have also inched up over the last maybe 5 odd quarters when I'm looking at your numbers. Give us some perspective on what's happening with regard to spreads.
So as far as the RBI, because of the RBI, whatever rate reduction have happened, that benefit will ultimately get passed on to customer. Reason being, there's adequate enough competition on the ground in the retail segment. So when our cost of fund goes down, everybody try to pass on that to investor to maintain their market share. So I think that will be benefit to the customer. However, as far as the Capri specific is concerned, because we raised 2,000 crore rupees of capital, and in any lending institutions, capital infusion is the biggest thing for capital rating upgrade. So we expect that our rating should get upgraded, and in case that takes place by mid of August or so, then we can expect that our risk spread will come down. So in a immediate term to medium term, our spread on the borrowing should come down. However, is again I said RBI rate reduction and other thing, ultimately it gets passed on to the customers.
Sir, sorry, I'm going to interrupt you for a moment. This possible upgrade in credit rating, this is very interesting. You're expecting that to likely come in August, and you're saying spreads will actually contract.
Spread will not contract.
Okay.
I said the risk margin will, the risk spread when apply on the MCLR will come down, which means our rate cost of funds will go down.
Got it. By how much, sir? What will that impact be?
So we expect that impact should be in the range of about 50 basis.
Okay.
All right, and point taken. So that's what the impact is that you're penciling in. This is Shreyansi as well joining in the conversation, sir. I wanted to quickly get a sense of what you think about your plans for geographical expansion. What are you penciling in there as well?
So geographical expansion, so far we are in the north and west. I think this year we are planning to enter in the south. We already opened some of the branches in the Telangana and Andhra. But second part of this year, we will start preparing ourselves to enter Karnataka and Tamil Nadu as well. And then we will add our home loan branches also. So the plan is in place. We are amid of the hiring of the team. And I think the team should be in the place by end of September or October. Thereafter, the branches will plan it out, start opening and hiring. So in the last quarter, we should see some activity happening in the southern Tamil Nadu and Karnataka. And next year, we'll see major expansion coming in the south. UP, we are going to add more branches because we are seeing very good traction in Uttar Pradesh also.
What does this do to your OPEX ratios, sir?
So the way scale the business more, I think technology investment and data science capability investment have already taken in place upfront. So now the AUM going from 22,800 crore to possibly 31,000 crore rupees, with the leverage on the operation will kick in, and I think that will give us the benefit in terms of our cost income ratio coming down. If you see that when we growing, our cost income ratio gone up to 70%, now it has come to 55%. We expect that it should come down further. In 2 years' time, we should stabilize about 45% or so.
What does that do to your profitability, sir? Because your profitability has seen a lift, 200 crore in FY23, 480 crore in FY25. So what does that do to profitability, and where should your normalized ROA be at? 4% plus?
I would say that normalized ROA, we are targeting anything between 3.75 to 4. And because we have built a very high quality fee income, there could be something uptick on that, but let us remain conservative. If we achieve 3.75 and between 4, and that is sustainable, that will be fantastic.
Right, and that was Rajesh Sharma, Managing Director at Capri Global Capital, joining us. Thank you so much for taking time out and helping us understand what your growth roadmap really looks like. But with that, we're completely out of time on this edition of Markets at 12. Thank you so much for tuning in. Do stay tuned, because we do have an interview lined up with Apollo Hospitals in just a short while from now.